rates on the long end of the yield curve, and also a large decline in short-term interest rates as the Fed has been cutting interest rates. So that is flowing through to more buying power for homeowners. Because so much housing, almost all of it, is bought using mortgages. It's a long maturity debt instrument. The housing market is one of the most sensitive parts of the economy to changes in interest rates. And so when interest rates rise a whole lot, housing is the part that slows down first. When interest rates fall, housing is the part that recovers first. Energy is a side of the U.S. economy that it's not a huge part of GDP, but it's really has huge swings. You know, when oil prices are high, there's a ton of investment. When oil prices fall, the investment falls off a cliff too. And so with oil prices relatively low this year, that's slowing down demand both for workers in energy, for capital investment in energy, but also for demand for heavy equipment, for trucks, for other logistics and support services for energy. It's very capital intensive and spills over to reduce demand for capital equipment in the United States. On interest rates, we think that this Fed rate cut that we had today is probably the last cut of this rate cutting cycle. The Fed has called this a mid-cycle adjustment. If you study monetary policy in your classes, you know the central bank raises interest rates to prevent inflation from overheating. They cut interest rates to support an economy during a recession or a slowdown and to lower the unemployment rate. All of these data added together collectively indicate that there's room for more job growth in the United States, so room for the Fed to lower interest rates there. And also, I haven't had a slide on it yet, and I haven't really been using a slide on it in my talks for the last 6 to 12 months because inflation, which is what I'm talking about, has been really boring and not really been a factor in the Fed's monetary policy for 2 years now, because inflation, by the Fed's preferred measure of the price index for consumption in the GDP accounts, is running at around 1.6%. It's averaged under 2% for most of this expansion. And Fed Chair Jerome Powell has said that, you know, even the times that we've temporarily gotten inflation back to 2%, it's been at 2% for a little while and then it's fallen again. And we've seen, comparing the US to other advanced economies like the Euro area, like Japan, that have had long periods where inflation has undershot the central bank's target and then have had to cut interest rates into negative territory to try to get inflation back to where we target it. Better to have the economy run hot right now and get inflation to average around 2% and even be above 2% for some of this period, so that we can make sure that inflation expectations stay around 2% and we don't have to deal with a deflationary situation like Japan had for much of the 90s and the first decade of this century. On exchange rates, this is something that I talk to about a lot with PNC's corporate clients and PNC's investment clients. Multinational businesses, they do business all around the world. They conduct business in the local currencies of the countries where they're operating. And so exchange rate swings have a large impact and can have a large impact on their expenses and their profits. All large banks in the United States offer exchange rate, foreign exchange hedging services, risk management services, including mine. And part of that is we provide forecasts for what we think that exchange rates are going to do. We expect that the dollar is probably going to depreciate over the next 18 to 24 months. That's if you're a foreign student and you have to buy US dollars to pay your tuition, that's good news for you. It means that the dollar is going to be a bit less expensive for students from most foreign countries. But we think that in the near term, the dollar is probably going to stay strong through the end of this year before that drop happens. Now let me talk more specifically about what's happening in this trade conflict or trade war, if you're too comfortable using the term, with China. These are the numbers in front of you that are how I've been thinking of the trade war. On the left-hand side, you see the U.S. trade balance with China. And a positive number, if we saw a positive number on this chart, it would mean that the U.S. is selling more to China than we're buying from China. A negative number means a trade deficit. We're buying more from them than we're selling to them. And the trade deficit, it went up basically steadily from the turn of the century through 2016. And in the last couple of years, it continued to go up through early this year. And then over the last 6 to 8 months, we've seen a modest decline in the trade deficit, but it's still higher than where it was 2 or 3 years ago. And that's just the U.S. trade deficit with China. U.S. trades with lots of foreign countries. And so you can also calculate the aggregate U.S. trade balance with all of our trading partners. And you see a little bit different of a picture here. You see, so this is just in U.S. The other major difference between these charts is the left-hand chart is in U.S. dollar terms. The right-hand chart is in share of GDP, and so it's relative to the total size of the U.S. economy. And so what you see here is that as the trade deficit has been rising over the last couple of years, it has been rising, but it's only been rising a little bit faster than the overall size of the economy. A lot of what's driven the larger trade deficit has just been a growing U.S. economy. But nevertheless, we do see that the trade deficit has increased as a share of the U.S. economy. And my understanding of why is basically this. So if you imagine that the U.S. economy is like a single household, like we have, our household has $5,000 a month in income, and we spend $6,000 a month. Necessarily, we're going to be borrowing $1,000 from the rest of the world. And the U.S. economy on balance is the same way. So the U.S. economy, we have total national income, and then we have total national spending. And the U.S. in aggregate, our totals are, if you think of the savings of the household sector, that's savings, that's the income of households, the income of businesses. You subtract out their household spending, you subtract out business capital expenditures, and you look at, you can measure the savings of businesses as their retained cash flow. You add those two together and you have private sector savings. And then you subtract out the borrowing of the federal government, the borrowing of state government, the borrowing of local governments. And that gives you the net savings balance of the U.S. economy. And that number is a negative number. We're on balance a borrower from the rest of the world as an economy. And that will show up in U.S. economic accounts as a trade deficit. So we have had the trade war has caused actually a decline in U.S. exports to China and a decline in U.S. imports from China. The U.S. imports are falling because we've imposed tariffs. U.S. exports are falling because China has retaliated with their own tariffs on our exports. And the overall trade balance with China has fallen a little bit over the last 6 to 12 months. But the trade balance with all foreign countries in aggregate hasn't really moved that much because the U.S. savings behavior hasn't changed, and that's what's driving that trade balance over time.
I guess I would disagree. The reason I would disagree is since the GDP has been growing, and this is a percentage of GDP, we actually are having an increase in the trade deficit. And in addition, that increase in the trade deficit is almost all due to the fact that the federal government is borrowing huge amounts of money that is coming from foreign countries to go and do it. And we cannot go and get rid of our trade deficit until they deal with the budget deficit on a year-to-year basis. I mean, we have a strong economy, yet $1 trillion deficit is unbelievable. It's never happened, even close. Economists I know, high-level economists, are scared to death when we go into a recession of what's going to happen, because you add another $1 trillion then.
$1 trillion here and $1 trillion there, and soon you're talking real money, yes. So I think that is a very valid concern about the U.S. economy right now. So my take, I mean, that's the trade the fiscal deficit as a driver of the trade deficit is one of the first things that I usually get a question about when I give a talk to clients. And my kind of perspective on it, and one of the hats that I wear at PNC is the exchange rate, the exchange rate forecaster. And so because I have to forecast financial prices, and I get my forecast wrong a lot, and I take really seriously whether I'm right or wrong on this. I like the price is, I attach a lot of weight in my thinking to what financial prices are doing at any given moment. And the price for the trade deficit, the price that I use to measure what's going on with US finances, is the 10-year government bond yield, which is, even with the $1 trillion deficit, still only 1.8% here in the United States. The 10-year government bond yield is much lower than the US in other foreign countries, but it's again negative in Europe, negative in Japan. So I think that over time, if we run ever-increasing deficits, at some point we probably will run into trouble. But to my mind, the price signal is saying I don't think we're there yet, and I don't really know when we get there. Total debt is around 100%. Debt in the hands of the public in the United States is around 100% of GDP, so $21 trillion right now in round numbers. But debt in the hands of the public in Japan is 220% of GDP. So to get from 100% to 200%, that's a much deeper hole we could dig ourselves if we and Japan has not yet at least run into trouble from their borrowing. So that is an important long-term concern in the United States. I don't think that's the sort of thing where we're likely to see a crisis. Even if we see a recession in 2020 or 2021, it's possible. I'll certainly acknowledge the possibility, but I think I would think that probably we would get a signal from financial markets already if that were a concern. I think the larger concern telegraphed by financial markets about what's going on in the U.S. economy or what's going on in the global economy is fear of deflation, both in Japan and in the Eurozone. But inflation kind of tracks all around the world. It tends to be similar, and so if we see global deflation or deflation in foreign advanced economies, it's going to spill over and affect us in the United States as well. Now, on Chinese economic growth, so I apologize I couldn't figure out how to get rid of this on the end of my explanation of the composition of growth there. But if you look at what's happened to Chinese GDP growth over the last couple of years, we have seen a modest slowdown in officially reported GDP. Chinese economic statistics are widely thought to understate the fluctuations in the Chinese economy. So if you look at other measures of economic activity, industrial production or retail sales or investment, which is reported monthly in China, and you compare them to GDP, you see much bigger fluctuations over the course of the cycle. So probably there's been a bigger slowdown in the Chinese economy and more fluctuations quarter to quarter than you see here. But even so, it's other measures of the Chinese economy and cross-checks on this show that China's economy does continue to grow and probably growing 2 to 3 times as fast as the US economy, even as it's been slowing. Consumption has been contributing an increasing share to China's economic growth over the last 10 years. And we think that we're probably going to see still, growth of 2 to 3 times as fast as the US economy over the next 1 to 2 years, even as this trade war is definitely a headwind to Chinese economic growth. So we're forecasting specifically real GDP growth of under 6% in the fourth quarter of this year. We've had the weakest real GDP growth in quarterly terms since quarterly data began in 1992 in the third quarter, and we think it gets weaker from here. Probably stabilizes in 2020 because of I think we're going to see more stimulus efforts from the Chinese central bank and Chinese government going forward. We haven't seen the Chinese government really try to stimulate the economy to offset the effect of this slowdown, at least not yet. And the big reason for that is going back kind of 3 to 5 years, China began a program of deleveraging, meaning that they wanted to see the amount of borrowing in the corporate sector start to grow slower than the size of the corporate sector, start to grow slower than the overall economy. In the aftermath of the Great Recession, of the global recession of 2008-2009, China had a really rapid and really robust recovery beginning in 2010, and had really rapid growth after that, even while the rest of the global economy remained quite weak. And the reason why China was able to have such a robust and such a rapid recovery and be so delinked from the global business cycle is because China's government and the Chinese Communist Party controlled the state-owned banks. They told the state-owned banks, go out and lend and create economic activity. The state-owned banks lent to both to state-owned enterprises as well as to private companies and private real estate developers. And so everyone saw the boom going on around them, then investment was robust and the economy grew. Over time, the problem with that is eventually the amount of money that companies borrow becomes too much, and if it gets really out of hand, like with the U.S. fiscal deficit, at some point it gets to be too much and there's a crisis. And it's difficult to anticipate beforehand when you get to the crisis, but once you get there, it's usually too late to correct course and to prevent it from getting out of hand. So China has tried to get ahead of this problem over the last few years by slowing the growth of corporate borrowing. We still do see growing leverage, growing debt in the household sector, growing debt of the Chinese central government, but on balance, the total amount of debt in the Chinese economy has been growing slower, which means we're less concerned on the one hand about these kind of long-term risks of China's financial stability. On the other hand, it means we're more concerned about how fast China's economy is going to grow in the fourth quarter this year, next year, and the year after, because China is constrained, if not by their hard ability to increase credit, they're constrained by the government's view of how much they could add to credit in the market economy. My expectation for trade policy is that I think we're probably going to see tariffs stay in place for quite a while, and they're more likely to increase between now and the presidential election than to be reversed. And this is kind of my understanding of the Chinese and U.S. government's negotiating positions in a nutshell. On the left-hand side is the U.S. government's understanding, which is that we hold the leverage in the trade negotiation with China because China is much more dependent on exports to the U.S. for Chinese jobs and for Chinese GDP than the other way around. On the right-hand side is my understanding of the Chinese government's strategy, which is that China had a leadership transition in 2013. After the leadership transition, they changed the constitution so the president can be president for life. And they don't have an election coming up, and we have an election coming up in next year. So even if the pain for the U.S. economy from the trade war is less than the pain for the Chinese economy, the U.S. political system is more sensitive to that because of elections than China is. So with both sides kind of thinking that they have a leverage, my assumption about tariff policy is that we kind of stay where we are and we see further stalemate for a bit. The headlines out of the financial press is that the two governments' negotiating teams think that they're close to a phase one deal on tariffs, which could go in effect in November. And it's just a guess. My guess about all of this is that if we do see a trade deal, it's going to be like the last time we saw a trade truce in December of last year, where we saw a truce, and then in May of this year it fell apart. So I think more likely that we see that than we see a long-term resolution. On the yuan to dollar exchange rate, I think we probably are going to average around the weakest level of the yuan on a year-to-date basis in 2020, so 7.15 per US dollar. I think we're probably not going to average that much weaker than that. We're actually a little bit stronger. I think it's between 7.0 and 7.1 right now. So I think that the yuan is relatively strong right now versus where I expect it to be next year. But this forecast is assuming that the additional tariff hike in December does go into effect. So that's my thoughts on the trade war in a nutshell. I'm happy to take questions if you have any. Yes?
Yeah, I have a question on the economy running out of workers. What do you fall personally or professionally? Are we running out of workers, or we still have a lot of people?
A lot of workers in this room. I think you can no longer find experienced, skilled workers who are willing to work at the wage that companies are offering their current workforce. So that means that either companies need to raise their wages for the new hires, which means that probably the people who are already working for you are going to want the raise too, or you're going to have to hire people who don't have the skills and train them. And I think the businesses that are going to be successful in the U.S. over the next 2 to 3 years are going to be the ones that have really good training programs.
When you raise the wages, though, that basically creates a higher rate of inflation. And the Fed takes that as a signal
I-
stop lowering and raise rates?
I think higher wages, so right now wages are on average in the US are rising at around somewhere between 2.5% and 3%. And anecdotally, I've heard from people managing manufacturing businesses that if you're looking for people to work on a production line, blue collar workers, it's rising much faster than that. I think the question for inflation is whether output per worker is rising as fast as wages are. And over the last, 5 to 10 years since the end of the Great Recession, output per worker has risen a little bit faster. Productivity, yes, has grown faster than wages. And so that means that, business margins should have been able to expand if you assume that other inputs to costs have held steady. I think that probably, at least for a year or two, even if wages are outpacing inflation, it's not going to cause the sort of inflation that, I don't think it's going to be anything like the 1980s. But I think,
Maybe the 70s.
I wasn't there for the 70s, but I don't think it'll be anything like the 70s either. Yeah, I think we're a long ways off from
Yeah,
that.
I seen one of your competitors,
Mhm.
economists, speak
Okay.
a couple of weeks ago. He said, sure, there's people available to work. The thing is, like 2 million of them are in prison, another 10 million have felony records, and they can't, nobody will hire them. And then there's like another 15 million that are strung out on opioids, so they're not really available.
Yeah, I think hiring practices are changing. I think I've heard anecdotally that the way businesses use drug tests today, I'm not speaking about my company
Right.
specifically, but the way businesses use drug tests today is different, from what they did in 2012. And I think the way we have heard a number of public announcements about the way businesses incorporate or choose not to incorporate criminal background checks in hiring is also changing. And I think, that businesses are trying to figure out, how do I add to my workforce given the pool of workers who is available in the United States in October 2019?
It's kind of like don't ask, don't tell.
I think it's an experiment for a lot of them to figure out, what are you going to do? It's a lot of it actually. I think a lot of businesses are looking to older workers, which is the fastest growing part of the U.S. labor market right now. Workers over the age of 55, I've talked with a lot of accounting firms, and I've heard, we're looking for ways to get people to come back out of retirement into work part-time and still be effective. So I think along every dimension, businesses are trying to expand their labor pool.
Fair enough.
So we have time for questions.
Any
Go ahead.
Any question from a student? Oh, okay.
Is it advantageous for the U.S. to diversify our trade deficit, and is it good for the global economy for us to do so?
That's a complicated question. I think the really simplistic, if you take like a really simplistic macroeconomic view of global trade, the U.S. will have the most goods and services to consume if we're importing them from the cheapest place. And if that's China, that's fine. If Southeast Asia is exporting labor-intensive products at lower prices in China, then Southeast Asia is fine. If it can be produced domestically in the U.S., that's fine. What we've seen in the last, I'd say, 2 decades is that the world is more complicated than that, and the huge decline in manufacturing jobs in the Midwest has had incredibly deleterious effects on communities and economies in this part of the country. And so there are other things to factor in about where you want to have jobs and what are the costs that the U.S. economy is willing to bear. I think there's a lot of it is a value judgment, and so it's more complicated than just the cheapest price. And I think a lot of it also is looking at what are the kinds of jobs that will be what kind of lifestyle and jobs are available to Americans given a certain set of economic rules. I think that applies to trade and to many, many other economic policies. Okay?
They say that President Trump's tariffs were about like intellectual property theft. I know his senior economic advisor, Gary Cohn, said he would have dealt with it differently than tariffs. If you were in either Gary Cohn's shoes or President Trump's shoes, how would you have dealt with the intellectual property theft?
So the options that the options that the U.S. government has for dealing with intellectual property theft, I kind of see three ways. One is what we're doing right now, which is taking this very aggressive approach where the U.S. takes on China directly. The second would be a slower and more frustrating way to go after China, where instead of just the U.S. imposing tariffs on China on our own, we very slowly and through difficult and unpleasant diplomacy, we build a coalition with other economies that have similar intellectual property protections, like Japan and the European Union and Canada and so forth. And we say, okay, we're all gonna take this unified approach to China, and if China doesn't do X, Y, and Z, then we're gonna impose tariffs on them. A third approach would be to build that coalition again and say that, combine the kind of penalty, the stick, combine carrots with sticks. So in addition to saying we'll impose tariffs on you if you don't play by our rules, we'll say that, well, okay, if China reforms the state-owned sector and removes state subsidies from state-owned businesses, if China respects intellectual property law in the same way that foreign countries do, then we're going to reduce trade barriers to Chinese imports that we still have kept in place even after China joined the World Trade Organization. The Obama administration, I think, was close to doing option 3 with the Trans-Pacific Partnership, which it was technically not a trade deal designed for China to join. China was not invited to the table for TPP, but a lot of the details of what was in TPP, if China were to eventually be invited to join, it would address quite directly what those or it was designed so that it would have gone after state subsidies for state-owned enterprises and intellectual property. TPP didn't pass. It was unpopular. So I think the challenge of going after China is you need to find an instrument that you think is going to work and also that's politically feasible in the U.S. political system. It's a very difficult task, and I don't think there's a simple answer.
Any other questions?
Can I get one more quick one in?
Sure.
You've talked all about conventional ways recessions come about. Do you foresee any like black swans sitting under the surface like we had in 2007 and 2008?
Mm-hmm.
You talk to people economists in 2007, everything's going great, it's really fantastic, blah, blah, blah. Then all of a sudden, the mortgage crisis comes along,
Yep.
and us lay people just kind of like, were surprised by it.
Yeah. So in terms of what could surprise us, or what we're watching as triggers of recession, one of the sort of widely acknowledged vulnerabilities of the U.S. economy right now is the leveraged loan market, which is it's a kind of non-bank credit extended to corporations in the U.S. and extended at with more lenient lending standards than traditional lending, and that's grown really rapidly in the last couple of years. Even the president of the European Central Bank is not even here; it's a foreign country to him. But he said that he is encouraging Euro area banks to look really closely at their purchases of financial instruments backed by leveraged loans in the United States. If they don't want to buy those negative yielding bonds in Europe and they want to buy something from the United States, be careful about that part of the U.S. financial system. A lot of people talk about a student loan bubble as a concern for the United States. We did a research project on that recently and did a lot of work on that. I don't think that there's a student loan bubble in the US. I think there is, there are serious problems with student debt in the United States. And the biggest problem ends up being for people who, they go to school for a couple of semesters, they're not able to finish their degree, and then they end up with student loan debt, but they don't get the degree at the end of it. So it ends up being, it's a huge problem for people in that situation. I don't think it's going to cause a crisis for the U.S. economy, because the dollar amounts that you're talking about, the typical borrower who ends up in default on a student loan, they owe a couple $1,000s. So not at all to make light of the problem for people who are in that situation. It's a really big problem for them, but I don't think it's going to affect the overall financial system. And those student loans are mostly made by the government anyway, and if the students can't pay it back, it just turns into more government debt, which 1.8%. The government they can afford to borrow. Yeah, trillion here, trillion there. Yeah.
I'd like to thank everyone for their coming this evening. Let's please give a round of applause to